All right, good morning, ladies and gentlemen. This is Clueless A Trading Frank. This is a free new member introductory webinar, as we do with all our new members. We have quite a few of them who have joined in the past couple of weeks, which is always encouraging. And this session will be recorded and uploaded to the Clueless A Trading YouTube channel, um, so anyone can listen to it at their own time, not necessarily sit here for the next hour or so. So I'll try to keep this brief, straight to the point, and go over a bunch of stuff which are going to be useful to all of you. Full disclosure: this is purely for financial education, not for any solicitation or advice. And we shall begin. It is Sunday, a slightly rainy Sunday here on the New Jersey, New York waterfront. It's 10:15 a.m. Eastern Standard Time, and here we go. So, first of all, welcome. I want to start off with some broad comments, then skim through a few important things. Technical analysis in its entirety is not an exact science, just like anything else in life. But technical analysis offers us a more of a structured view. That's the way I look at it. More of a structured view as to a roadmap, so that we know what we know where we can go up and down in real simple terms. There's an old saying on Wall Street which says fundamental analysis, which is the research part of it, knowing about a company, all their numbers, their whole fundamental balance sheet, their income statements, their earnings per share, the PE, all that stuff. That gives you an insight whether or not it's a viable company. It does what it doesn't tell you, which is really the core essence of trading and investing, as to when to buy it, okay, and when to sell it. And as traders, we're in the business of buying and selling, um, which is basically a accelerated version of investing. Because as investors, you also buy and sell, but over a longer period of time, hopefully. So technical analysis, like I said, is not a exact science, but used in used effectively, it's extremely powerful. Now, my job here at Clueless A Trading and my service is not, as I've said it before many times, to train my members into getting a PhD in technical analysis. Okay, that's not my goal, because I'm not a PhD in technical analysis, for a better choice of words. I'm simply somebody who has taken of the basic tenets of TA, or technical analysis, and adapted it to my way of structuring charts. Just bear with me one second. Had to nibble on some cacao beans. Okay, good stuff. Instead of drinking too much coffee, you have a cup of coffee, and then you have some of these real dark coffee beans, or cacao beans they call them, not cocoa. They're really good for your health and energy. Okay, so saying all that, so what I try to do very effectively is, I basically, over a period of years, and I'm constantly adapting, just like anything else, and I'm constantly learning, constantly adapting. Um, I've structured my charts in a way that is readable, understandable, and even then, it gets very tough at times, because that's the nature of the markets, to be extremely volatile. And along the way, I'm pretty much 70 to 80% plus all the time, which is a pretty high ratio. My targets are reached over a definitive time frame. Can somebody please mute their mic, please? Thanks. But along the way, what I call, we get these scenic and sometimes not scenic, ugly detours, which we call volatility. All right, it's really as simple as that, and that's where traders, um, in general, get completely messed up. That's where the biggest money is lost, because they don't quite understand. They get scared. The emotional part of our brain goes into effect. You do stupid things, and then you sit there, and it gets exactly there, and you're like, oh my God, And this happens over and over and over again. Okay, when real money is at play, because we're not paper trading here. I certainly am not, and this is my living. And when real money is in play, we all tend to take some brash decisions sometimes, and I try to minimize that as much as possible through my charts. In simple words, you stay with that trade, whether it's a long trade or a short trade. Dollar cost average, stick with it. Doesn't matter what your P&L looks like on a certain hour, your profit and loss column. Doesn't matter what it looks like at the end of the day, or maybe sometimes even 2 days, because you need to basically focus on this chart. And if it's projecting a higher probability, there's nothing 100% in life or in trading, but if it's projecting a higher probability that it's going to get there, it's going to get there one way or the other. All right, and that's the nature of the beast. Now, there are certain times when there are truly perfect moments, and those are the times the average retail emotional investor, as I like to, that's my sort of common term for what do you call the average trader, um, never appears in the picture. They just don't appear in the picture, and those are truly the perfect times. And pretty much by looking at this chart what they are, because in hindsight everything's 2020, right? So you look back and you said, oh my God, I should have really bought hard at that point. But the point is that nobody's around at that time. And trust me, I know traders and investors. I've worked on Wall Street for 14 years. And I'll tell you, 14 plus years. And I'll tell you, I know the mindset of very wealthy investors. I know the mindset of how institutional investors think, except they don't, most of them don't even have a mind. And I also know what traders think and how they behave and react. Now, that's just out of experience, and I'm also a pretty good reader of behavioral sentiment. That's one of my strengths, and and I and like I say, it's the same old story over and over again. And I know people try to change and say, no, I'm not going to do that next time. I'm not going to I'm going to buy there. I'm going to sit there, but it's hard. And guess what? These volatility algos, these machine driven markets, which read your sentiment by your actions or your non action, will want the least amount of traders and investors before they take off. And that's the reason why, from a behavioral standpoint, we had the largest amount of outflows from the mutual fund complex. I think in the range of 30 plus billion dollars in the month of February and March. Mom and pop is, when they run for the hills, they run hard. And since 2009, and this is facts, when was the bottom of the market? Okay, bottom of the market, 2009, March 9th. I was at my desk, on Wall Street. Trust me, I remember that day. That's the day the market turned. And it hasn't looked back. And it's been a lot of big corrections along the way. But we never hit that bottom. Since that time, the overall inflow in the US stock markets has never been the same. In other words, the least amount of money has gone into the US markets. I'm talking about direct money, like as in calling up your broker or calling up your mutual fund company and saying, hey, I want to put in $30,000 in that thing. And I'm not saying it's like completely disappeared, but on average, it's not there. So without me kind of moving on to it, that's a completely different aspect of it. It's not really technical analysis. What I'm trying to get at is, as traders, we have to try to be as unemotional as possible. And these charts allow you to do that. That's it. The more you practice it, the better off you're going to get at it. Is it going to be easy? I'm a very straightforward guy. No, it's not. Is it that hard and rocket science? No, it's not. All right. So somewhere in the middle lies the truth. So on that note, let me just go over a bunch of the real basics of what happened to that? Real basic of going back to square one. Now, this videos and stuff in detail explanations are on my YouTube channel under the new member introductory videos. Feel free to listen to it, like I've told everyone from day one, and that's under new member introductory videos, chart pattern analysis, all that stuff. Click on them. It's very, very resourceful, and it's going to help you out a lot. So there are some basic technical patterns that occur all the time in the market. I show that on my charts as much as possible. These ones are extremely powerful. Ascending triangle. Remember, you have to look at my charts in order to understand what I'm doing in order to make the big money or the small money. Okay, so got to review the charts, and then you know what I'm talking about. So the ascending triangle, just showed it recently on a bunch of stocks. This is a very powerful setup. And bottom line is it keeps on making a double top, triple top, and then it breaks out as long as the uptrend line is intact. And during these times during these times when it surges and then pulls back a little bit, let me change this color, pulls back a little bit, then it surges again, hits that top, pulls back a little bit. These are the times, let's say you got in here. In most cases, we are my tactical alerts. I would say in majority of the cases, especially during heavy turbulence in the market, I tend to get in very close to the bottom, if not at the bottom. Okay, especially during times of real violent corrections or pullbacks. So let's say you said that's it. I'm alerts there. You got in with on your first trade on that. You put in a small amount, whatever. And in fact, in hindsight, that's where the biggest amount of dollars should go in, right? When we look at the charts, we'll see it. But we don't do it. I try to do it as much as possible, but I'm not here to push you to do what you need to do. Everyone has their own risk tolerance. And if they're too comfortable because their mind is saying, oh, I want to be comfortable, they're never going to make money. You got to buy the maximum amount, or you got to enter the markets on a technical basis at levels of highest discomfort. Okay, you can write that down. That's when you will, highest discomfort, technical setup equals big money. I'm saying you, it equals big money. Never has been proven wrong. But the technical setup has to be right. You will be jostled around after you get in there, but it has to be mentally uncomfortable. When you're mentally comfortable, you're going to lose money. No question about it. All right. But once you make that big money, you got that comfort zone or cushion. So saying all that, so these are the times when it starts to do this stuff is when the average trader, because they're just watching prices and not the charts, they screw up. They sell. And they lose money, or they make very little, and then they see the breakout. That's an ascending triangle. This is an average triangle, and I've shown this too multiple times. Stock does that, or the market indices does that. It can either break out or it can break down. Now, this is just the upper end. As I've always said, we're just looking at the surface, meaning the upper end. Here's your charts, here's your chart patterns, right? And down here is the diagnostics, which is what we call internals, whether it be the stochastics, which tend to move like that, and all kinds of different indicators, what we call internals. Before I go any further, and this is on my other video too, this is the way I look at things, the simplistic way. The chart patterns on the top are showing you movements in prices. So a lot of traders, I don't know how they do it. I don't think they do it. That's why they keep on blowing up. They just look at prices. Yeah, the price is moving. I get it. Great. So you got to look at the prices. Of course you do. But you got to look at the chart pattern too. But the chart pattern alone cannot tell you overall what is going to go. And that's where I come in with these internal indicators, and I show some very simple ones, because on average I monitor about 32 of them every day in all my screens. I got a heck of a lot of screen space to look at things, all right? But I don't put too much of them there to confuse people. So the internals and these are the externals. So the externals are your chart stuff and the prices. So the analogy that I draw is like going to a doctor. If you go to a doctor and you're not feeling good and he looks at you and he knows you're sick, so he knows, he can, but he doesn't know what exactly is wrong with you, right? So when he does that slew of blood tests and all that stuff that you do, then he finds out those are the internal reports. The internal reports will tell you how sick you are, what the exact medication is needed, and what works. That is the most powerful combination in making money in tactical trading, which is the charts, understanding, even a basic understanding of the charts. And some people, pick it up and they're like become like super duper pattern recognition, all that stuff. It's just a matter of practice. Some people just have a more, their brains are more geared towards looking at visuals and understanding my charts very quickly. And some people, it's a little bit slower. And that's nothing wrong with it. But I think anyone can get better and better. The more you look at it, the more your eyes talk to your brain. So the internals is where I come in and I show, what the stochastics are deep oversold, blah blah blah, all that stuff, and you mix that up, and you tend to trade. Your effectiveness as a trader and making money gets better. So, um, so here we are looking at the externals here. So the triangle, then we have the channel up, where the stock is moving up, and the channel up can take two forms. It can either break down, or it can break out. And so again, the way I determine whether or not it is going to break up or down to a high degree of probability accuracy is by studying the internals. The rising wedge is a very common pattern that occurs all the time in the markets, and stock is moving higher, stock is moving higher. It gets narrower and narrower like that, and then it has a pullback. Now, behind all these technical patterns, and this is just few of them, but the major ones, is human action, right? Or machine action on prices. So let me give you an example why this is going on. So the rising wedge here, somebody gets in around here, he rides the wave up and down, sees the price, moving up, and then this is where you have, and then you have lesser and lesser participation that's why the wedge gets narrower or diagonal, lesser and lesser participation, because as the price moves higher, things are getting overbought. So people say, oh, the market's up a lot, or the stock is up a lot. And it creates a moment of indecision, and the last minute buyers come in because they're like, oh, it's moving up, so I got to get in there, because they're just looking at prices. So the people who bought at these levels, they just start selling hard. And now it's no longer people, it's machines selling hard, the algorithmic high frequency trading machines. So it creates an immediate consolidation channel of profit taking. Now they're not completely out, but they're taking their profits out. Now I've shown this repeatedly, as you know, these consolidation channels. These consolidation channels that occur, okay, right there like that, is where traders get completely, the retail emotional trader gets completely messed up in their head, because they might have come in late, and these consolidation channels can be intraday, so they get busted out like, oh my god, I gotta get out, the prices are dropping. It's nothing in most cases. If the internals are suggesting that the uptrend is still intact, a term that I use all the time, then this is nothing but a time to cost average down. In other words, if you bought something, you came in late and you bought it, let's say at 4, let's say an option, and by the time the consolidation is going on, it's at 3 or 2, well, this is looking a lot like a bull flag. I've shown this repeatedly over the past couple of weeks, over the past couple of months, and it's worked almost 90% of the time. Go look at my charts. Okay, so instead of messing your brain up and dumping your stock and running away, you need to understand what I'm showing on my charts. And if I'm saying it's a consolidation channel, I'm not God. I don't control the markets, but it's going to be a fair shot that it is one. So you need to cost average down, and then it breaks out. That's also known as a bull flag, right? Something moves up, creates a kind of a flag pattern that is also can be a consolidation channel. That's also a flag pattern, and bang, it goes. So traders get messed up and they sell, and then they see how much money they could have made. And it's a very simple uh, trading motto, right? Or dictum. If you what you don't make is what you lost. It's quite simple. Okay, head and shoulders. Head and shoulders is like, flipping the birdie. There you got the thing. You got the left shoulder, right shoulder. Um, the market was in a broad. It's still kind of in a very broad head and shoulders pattern. So we completely haven't negated that pattern. Head and shoulders is a bearish pattern, right? So I've shown head and shoulders quite a bit. It's a bearish pattern. And then right at that where the thing is, neckline. And when it breaks the neckline, it tends to rapidly move down. It's not like a bear market starting, but that's how it happens. You get the left shoulder, the right shoulder, the head, and the opposite of this, which I play very effectively, is the inverse head and shoulder, which they don't show here. The inverse head and shoulder is just the opposite of that. Okay? I'm trying to put that up. That, ladies and gentlemen, is an inverse head and shoulder with a neckline. And when that neckline breaks, or even before it breaks, because I tend to buy around here by the time I start to see the formations. Now, the predictive analytic part of technical trading, that's for advanced students, and I highly suggest in the not too distant future, all of you, I think Neeraj already is, what do you call, sign up for the advanced coaching sessions, because believe me, if you don't see immediate results, in my opinion, on your trading after you take those ACS sessions, a 5-pack session, I would say everyone who's taken that, they have seen some pretty immediate results, because the messaging they're getting from my charts, they're understanding it a lot better. So, but without getting too technical here, this is your inverse head and shoulder with the head, left shoulder. So what I was saying was the predictive analytics part, like what might happen, because that's where their big money is made. Over a period of time, after you take the ACS session, some people keep on taking it. It gets it fine. Finally, they get it. Okay. So that's not something that comes naturally, believe me when I tell you, because there's a whole bunch of different things that are going on, and I explain it in very simple terms, and you basically keep on looking at it from your side, and believe me, at one point, you just get it, and it just feels good, believe me, all right? So that's called predictive analytics. But for now, like I said, that's my job to do, to predict and doing all that. But if you can be on the same boat too, trust me, that's a powerful combination. So there we go, inverse head and shoulder. Then we have the triple top, nothing to explain. It's a triple top. It can't keep on busting move over the resistance, so it falls below the floor. I have a very simple theory, because it's law of physics, law of nature. If you keep on thumping against the floor really hard, at one point it's going to break. If you keep on banging the roof over and over and over again, then the roof is then you're going to break out over there. If you keep on pushing multiple times, possibilities you break out. But if you keep on failing and you keep on hitting the floor more, then that's going to break down, and that's simple. That's your triple top. This is the flag pattern that I mentioned. Nothing new here. Consolidation channel, then the breakout, then the double top, which is an M formation. The opposite of that is the double bottom. Okay, what we call dragon bullish. We don't make this up. That is actually a term. Okay, so the dragon bullish is a very powerful pattern. Very. You can play the W pattern or the dragon bullish, as I show. It doesn't happen a lot, but it does happen. When I see W formations, and especially on the swing setups, and I've shown that many times, that's where the big money is made. The big money is not always made on trading something for 15 minutes. During times of excessive volatility in the market, down 600, up 600, we've gone through so many of them, right? This year, since March and April. Some of the highest vol levels or volatility readings overall, even intraday, back and forth, that the market has registered in God knows how many years. Um, so those are the times that you can basically make some serious money intraday, 300-400% more. I mean, or more on those SPY, SPX calls or puts. But aside from that, these type of dragon bullish patterns, these are things that occur over. These are for swing setups over a multiple, over a couple of days, or even a couple of weeks. So very powerful. The W pattern. Uh, this is the pennant, they call it, which is to say, which is very, it's like a consolidation channel. This is also a pennant, which is a bull flag. That's the way I look at it. Inverse head and shoulders. Oh, they actually showed it. There's your inverse head and shoulders. The inverse head and shoulder actually doesn't really look like that, to be honest with you. The inverse head and shoulder looks more like this. And it's not perfect in real life, but this is what it looks like. You have a definitive head with the thing turned. You have the left shoulder. It comes down. It tests that same level or close to it. And then the neckline, and it breaks out. Very powerful move. Okay. Falling wedge. This is your falling wedge. And this is rectangle. It's really nothing. It's basically a trading range. All right. So you have a trading range. Stock or the market is moving within the trading range, lots of volatility. Sometimes the trading range is wide, where you do have the opportunity to make money short and long over a short period of time. And when we say short these days, I mean very short period of time. Sometimes minutes, sometimes hours, because the machines have compressed weeks and months into days and hours and minutes. You understand what I just said, right? The machines have compressed, the algorithmic high frequency trading machines, the speed and the frequency, and it's not going to change. This is the new normal. So get used to it. And that's why my service delivers some very powerful results, because I tend to predict and react a heck of a lot quicker than anyone else out there when it comes to algorithmic high frequency trading moves in the market. That's why I say this ain't grandpa's market. So a lot of people still trying to follow the old traditional way of trading and stuff. And believe me, they are not doing well. And believe me when I tell you that they're dead wrong on the forecasting part of the market. Because now, I repeat, years, months, and days are compressed within hours, days, and weeks. Everything happens very fast, fast and furious, upside and downside. If you think you're waiting around for your comfort zone, you're not going to make it. All right. And that's fact. So, so here's your falling wedge, another very bullish pattern. Now, what is the falling wedge? This is the rising wedge, right? The falling wedge is basically a stock is making lower highs. It is making lower lows. So shorts who shorted here, they're feeling good. You can trade these ranges, but if let's say for people who are extremely bearish on that, they keep on coming in, shorting, buying puts, shorting the common. Then the average retail investor sees this as, I read the stock is definitely going to go down. It is just that's it. It's Tesla's burnt more shorts in history than anyone else. All right. So Tesla is one of the highest short positions. And institutional investors are in there too, shorting the crap out of the stock. And there's a lot of falling wedges here and there on Tesla, because when it moves up, it burns those shorts repeatedly. But they keep on saying short because they think Elon Musk is an idiot. That's up to them. All right. I doubt it. So, bottom line is that the falling wedge, so shorts come in, they keep on hitting harder. The retail emotional trader who wants to short this comes in really hard. So by this time, it's causing the price fluctuations are getting tighter and tighter. The short position, I'm going to say SH, the short position is rising hard. They're all feeling this thing is going to go. Internals, by the way, are so deeply oversold that and I'm not talking about some penny stock here, I'm talking about a real company. The internals in the meantime are so oversold, it's not even funny. Bang, it breaks out. I've shown this quite a few times in multiple stocks. The falling wedge is a powerful powerful pattern, because it is propelled higher substantially by a monster short squeeze, which you guys probably obviously know by now, which simply means the shorts have to cover. Because the ones who got in here, they're losing money right, left, and center. The ones who bought here, they're still profitable. So as the stock is breaking out of this downtrend line, falling wedge, they are covering. In other words, they're buying back the stock that they sold short, and then new money comes in hard because they're seeing this falling wedge break out. So it's a very powerful combination. And so this is a consolidation channel, same thing like I explained before. That's the falling wedge. Descending triangle. Now, what is a descending triangle? It's simple stuff, okay? Your ascending triangle is this. Your descending triangle is this. This goes like this, and then it breaks out of this, the top arm of the triangle. And here, it keeps on doing this, and then it breaks down. That's obviously very bearish, and that's bullish. Okay, let's move on. It's always good to revisit this because these stuff, and even for me, because this is the basic tenets of what happens in the market. This is an interesting one found, okay? Reversal chart patterns. And we play reversals all the time, if you've noticed. Niraj has been with us a few months now. Kathy and Mary Beth just joined. Fantastic people. So we make big money on reversals, and calling reversals in the market is extremely tricky business. I have a pretty good track record of doing that. And when I'm looking at reversal plays, both on the upside and the downside, primarily on the upside, you got to get into those trades. So they're showing some reversal trades here, where that's your W formation. Doesn't get any bigger. Okay. It's a little small. So these are actual things that happen in the market, which I've shown in my charts repeatedly. So you get this. You get these patterns are very familiar to us. That's your falling wedge. Let me get the pen. There's your double top. Here's your neckline. Then it breaks below the neckline and falls real quickly. Okay. Just the opposite now. The W formation, double bottom. There's your neckline. Breaks out of the neckline. It moves very quickly. There's your neckline. It says neckline here. And the what do you call
Hey Frank, I have a question.
Yeah, go ahead.
So Frank, one thing I got it, like you will be doing some predictive analysis and then you will be entering the trade. Uh, so what is your triggering point? So like take
Okay.
a
Let me
ascending triangle,
yeah.
ascending triangle.
This is what I'm going to.
So
This
will
is
it?
what one second, Nirish. I know. It's a very good question. Let me quickly go scan this over. Then I'm going to go into my real charts, and then you ask me that question, and I'll show you exactly what my point of maximum entry is. All right. So let me just quickly cover this. Is that fair enough?
Okay.
And then you hold that question. Yeah. So these are all the different reversal patterns that they're showing, and I'm going to quickly scan through. We've gone through a bunch of them. There's really, I mean, those are the basic chart patterns. There's a lot more out there, and obviously we can't fit all that in. So I'm going to basically go into my charts at this point. So let's do this. Let's do this. All right. So let's look first at the broader markets, then we can look at a couple of individual stocks. All right. So let's say, for example, we look at the bigger picture on the market. This is the bigger picture on the market, and this chart was constructed on a Friday, and this is a very clean looking chart without really too much pattern stuff and all that. So I'm going to go to this one, which has a lot more. So now you can ask your question. So go ahead with your question, Niraj.
Yeah. So my question was
Yes.
like what is so initial triggering point that you were mentioning? So I was
Hmm.
taking an example of ascending triangle. So
Okay.
at that stage, beginning of that ascending triangle, you don't know whether it will become a ascending triangle or not. But
That
you enter the trade thinking that it will become. And is there, um,
yes.
do you consider any stop loss while entering such trade, or you just think
Okay.
like, oh, it will become, and if it is not becoming, then everything I'm putting, it is complete risk.
Okay, so basically, that's a very good question. When we're looking at whether or not an ascending triangle, Apple is a classic case I just showed, right? So I'm not just looking at the chart pattern. I am also taking into consideration multiple internal signals I'm getting from whether it be the stochastics, whether it be the McClellan oscillator, whether it be what do you call it, the DI indicator, directional indicator, all that stuff. So I'm mixing a lot of internals. Let me pull down Apple, and I'm going to walk you through that. Then I'm looking at what I do is, and that's how I'm making a determination whether or not it is a. Okay, there it is. So here's your ascending triangle on Apple. All right. Um, this is your basic triangle. Let me make this bigger. Put this green. So everyone see the ascending triangle here that we broke out of on Buffett Day on the 4th. Okay, does everyone see that?
Yeah.
Okay, because got it there. Now, Neeraj's question was, at what point do you kind of make a determination whether or not, and whether it's going to break out or not? So I'm looking at a lot of internals, and the simplest and the most effective internal that you need to look at, to be honest with you, is your stochastics, because stochastics is the second derivative of the relative strength index. So when the stochastics get deep, deep, deep oversold, especially on a market leader, one of the most powerful stocks that drive financial markets, then these things carry a lot more weight than a smaller stock. So I'm seeing this Apple, for example. I had this chart drawn a while ago. This is when Apple fell from 179 down to here. So at that point, there is absolutely no indication or early signal for an ascending triangle. It's a total breakdown. However, all these lines were drawn well before as Apple was crashing. Okay, and I believe that when I went back on this chart, there was a gap here. That's the reason why there's a dotted line. Okay, because each one of these lines carries some effective money making meaning. So this dotted line was a gap here, and as you know, gaps get filled up and down. So there was a gap fill here from October 30th, 2017. October 30th, a long time ago. All right. So that gap was this dotted line. There was also a very powerful support line in the form of this big fat green line, because we have traded Apple back and forth on this. Mostly, I don't like, really shorting Apple. I didn't really short Apple on this move, but boy, did I catch it. And this is not the first time. So this was your major support line, which was at $164.59. So when it slipped there was a good chance that this minor gap down here of 157, 158 would hold. I mean, would be the next level of contact. And of course, if everything went to hell in a handbasket, then Apple would basically be a screaming buy all the way down at the 150 level down here, which was a possibility. So when I issued my buy signal first here, and then here, as I saw this turn, okay, Apple calls went from roughly $2 to $3, because that's what they normally cost, to if somebody held it all the way, I normally take staggered profits as it's moving along, because I have no idea whether or not it's going to break out to these highs. They went from roughly $2 to $3. They went to almost $60+. Okay, so $2,000 would be $60,000 plus. And just do the math. All right, $20,000 would be $600,000 plus. And how many days did it take? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. Amazing. That's the stock market for you. So, answer to Niraj's question. So, as this stock started to move higher from this level and entered above this uptrend line, which was drawn all the way back from February of 2018. That's the last time the market had a big correction, and then of course Apple showed it too, and then turned on February 9. So here was my point of where the big uptrend line was. So once it entered the uptrend line, I'm a buyer here because I'm always a very aggressive buyer based on my levels. And in and a quick answer to your question, when you enter these type of trades, you do not want to enter with a lot of money, because you want some validation, some technical confirmation that things are setting up, and then bang, that's when you hit the pedal to the metal and put whatever your risk tolerance money is. Okay,
Mm-hmm.
so that is something I do very effectively. When I buy things, sometimes I'm seeing a bunch of stocks trades, and this is very important to you guys. And I'm seeing a big, massive breakout. It doesn't matter whether it's up $6, $7. Case in point, most recent one, yes, on Friday was TTD. Tech, what do you call it? What's the name of the company? I don't even trade that company that much. Now it's in everyone's radar. Trade Desk. I got into the calls at around $1.30. Okay, I bought a bunch of them. Within 15, 20 minutes, within an hour, it was up to $2.60. I'm up more than 100% of my money. So that's a momentum thing. It's moving fast. It's the candle's moving fast, and I've showed the chart quite a few times. I'm still long a bunch of them because that stock is like on a major breakout. And so here, as it enters this zone, let's say, for example, you didn't buy here. So the second day, the stock basically, that's the earnings, I believe, and we won nicely on the earnings because I bought a bunch of calls. So and there is always risk, but it's not like you're putting in your whole trading capital in the one trade. That's what a lot of traders do, and they just simply blow up. You can't do that. Doesn't matter how small or big your account is. You cannot just pile into one thing, even though that could have taken your account up 300%. But I leave that to you guys. So saying all that, once it enters the uptrend channel, that's when I'm starting to see the first signs of that of the ascending triangle come into play. Now, whether or not I think the ascending triangle is going to break out, if I see this was, I think, the Warren Buffett thing where the stock was up from 178 to 183. Big $5-6 is a lot for Apple in one day. So you see something like this, Niraj, with a bullish engulfing candle, that's billions of dollars. I can't even calculate. Going in that hard, that big, you have a pretty high certainty, given also the shape and the formation of the stoves, getting overbought and basically rushing towards the overbought zone, which is, believe it or not, a good sign. You match that in very simple terms with a candle of this magnitude, a bullish engulfing candle, which is worth very large money, hundreds of billions of dollars, then you have a very high probability that this ascending triangle is going to break out. So that's the direct answer to your question. This was a clear-cut play. Apple's still going to go higher. Apple's still going to go higher. My charts are showing it. I have a bunch of the calls. Apple's going to eventually land up. And mark my words, okay? At that 204 level, which is the $1 trillion mark. It's going to do that. It's only a few percentage points away from here. Now, along the way, is it possible that it slips down towards 184 and basically, test the breakout level of the ascending triangle? Absolutely. No biggie. So this level here, the 203 mark, now somebody thinks this is going to happen tomorrow. Well, no, it's not going to do that. Can it happen really quickly, even by this month? Yes. Okay. So, but all I'm doing is I play Apple for a couple of points at a time. So Apple hits that 192 level, 190 level even. I'm nicely profitable on my calls. And there was a minor consolidation on Apple, which I was watching on my other chart too, which hit exactly the point where it turned. and that is being shown here on the daily chart, because during the day, Apple was, pulling back a bit, is in the form of a small red block known as a inside day. In other words, the body of the candle, of the sell candle. There obviously has to be some profit taking, but that's the time that I keep on, that I buy. They started to panic here, and the world said, "That's it, Apple's done." You turned on the, all the analysts, even Tony Saganucci, whatever his name is, he's like, "No, Apple's gonna really, be a bad, bad iPhone number, blah blah blah." Don't they realize these guys get paid millions of dollars for being stupid? I love it. I saw a lot of that on Wall Street. Maybe that's one of the reasons I basically decided to just be on my own. Because the cheaper Apple gets, what do you think the value investors do? The conservative investor, the mutual fund managers, they buy the crap out of it. Because the more they buy it, they're getting a 6 to 7% dividend yield. So wouldn't you be buying Apple at 160 and locking in a 6+% dividend yield, with the possibility that they're going to raise their dividend rate and boost their buybacks, which they did? So you win, win, win. Don't want to be, the value fund managers are not necessarily buying Apple here. The growth guys are, and we're traders, so we're buying for a couple of points. So that was another reason. As it got cheaper and cheaper, I said these guys are gonna, it doesn't matter what the iPhone stuff is. And then Apple showed that the iPhone sales not only held their ground, their service business, which is basically apps and all that stuff, is booming. So they got killed. All right. The hedge funds got killed. The big shot analyst who basically drove a lot of institutional funds to short Apple, they all got killed. Big money can be very dumb. Okay, repeatedly. So Apple's pretty much going here. So there's your answer to your question. When you see a heavy-duty bullish candle like this attacking the previous high, the chances and the probability of it breaking out, and this is a bull flag right there, another type of bull flag, right? That is very high. So does that answer your question,
Yeah.
Niraj?
Yeah. So Frank, my other question was,
Go ahead.
so for the initial entry that
Uh-huh.
you entered,
Mhm.
so at that stage you won't be putting any stop loss. You will be just going
Okay.
with
Let
full.
me explain one thing about stop losses, okay? And I you know me, I talk very straightforward. I am bad with stop losses. Now, why do I say that? I'm bad with stop losses because I am so immersed in my charts that I have a very high tolerance for volatility. Okay, so because I'm seeing um this is real intraday volatility. Now listen carefully, guys. This is a very important question that Niraj asked, which is very important to all traders. So this is from the, what day was it? From the 8th, and the 8th was Tuesday, and this is from the 8th. So this is from Tuesday. So look at this chart. From Tuesday, this is what the markets did, and I basically walk people through it. So my point is that if I'm putting stop losses on trades, and these type of quick, fast, quick, sharp, 15-minute, an hour long, each of these candles are 15 minutes. So 2 hour long pullbacks come in. I have lost more opportunities by using, and I'm not suggesting you do what you guys want to do, but this has been my experience in volatile machine driven markets, that as long as I have a directional bet on that stock or on that market, SPX buys, whatever we're trading, I have mental stop losses. Because if I put real stop losses out there, my experience has been I have been taken out, not re-entered. I have lost more money by having stop loss programs take away my take away my options, than I have in using stop losses to protect my capital. Now, does that mean that you'll be 90% down and say, "Oh no, it's definitely going to go higher"? No. Have a mental stop loss. My mental stop loss on average is around 60%. So if I'm putting $1,000 into a trade, into an option, give you a hypothetical example, I'm willing to lose $600 to $700 on that trade. But I will use mental stop losses, because the minute I put actual physical stop losses, but if it's a larger amount of money, you certainly want to put an actual physical stop loss. What's going to happen is you're going to get these quick, fast 1 hour type of corrections, 15-minute type of corrections. Not 15 minutes, yeah, sometimes 15 minutes, but let's say an hour or two long, a quick consolidation correction within the band. They'll take you out. The machines will take you out. That's almost a guarantee. And then they're going to run the market literally 10 seconds after they take your stop loss, after they stopped you out. That's the reason why during times of market volatility, you notice when I go in for the short, not at the top. Like if I see a real signal, I go in for the short at the top, right? But let's say, for example, in something like this. This is the daily chart that was here. So let's say, for example, on something like this. This is a daily chart, right? So you start to see a very large acceleration candle, which creates a substantial bottom. In this case, it created right here. Right there is the wick. This is a hammer reversal. So most of the stop losses were in this zone. The machines move instantaneously, pushing it down, so every one of those stop losses are engaged, taken out, and then comes, and that creates a massive reversal. And those reversals are substantial amounts of money. Same thing here. Look at this. This is it. There's your hammer reversal. What's a hammer reversal? All the stop losses are taken out, and immediately the shorts cover, or the so-called smart shorts cover, and new money comes in, and you have 800-point type of moves in the market, 600-point type of moves in the market. That's really what these candles are happen. So in answer to your question regarding stop losses, the way I do it is I have mental stop loss, and I have a higher threshold for pain. So because I've noticed that when I feel the most, and I'm talking myself, when I feel the most painful, emotionally speaking, like from a monetary standpoint, like look at that trade, I'm also focusing on my charts. Unless there is a substantial breakdown without any likelihood for a reversal, then at that point I will have to eat my losses. But what I do, I always have cash on the side, and I always, as you know, dollar cost average. So if I have a call option at 6, okay, and that thing, because of an instant sell program, crashes down to 3, which happens, okay, let's say an SPX call at 6 and it goes down to 3, I tend not to panic, because I'm looking at it as this is a 15-minute chart. This is a very, very helpful chart for people who are trading not just intraday, but people who are looking to cost average and see what the markets are going to do during the day or over the next couple of days. All right, the daily chart is a great longer term GPS. This is a great short term GPS to see what's happening intraday primarily. So when I'm seeing this, and I'm noticing that this was and this is not like 100% correct all the time, but I'd say it's good 80% of the time. It's very correct. So I'm starting to see the stows nicely oversold. That's why I have these arrows here. These arrows are not put here, just to make the chart look pretty. These arrows are here because it's literally telling you to focus on where these pullbacks are. So these mini pullbacks are sharp. They happen very quickly. We're up 100 points. All of a sudden, up 50, up 30, up 20. The average trade is like, oh boy, here we go again, because the volatility programs are tuned in to know exactly where those stop losses are and where the retail trader and the stop loss guys are going to panic. So they immediately push harder. They push harder. The hedge funds do it all the time. So they push harder, the machines. They take your stop losses away. So I'm looking at this stuff. As long as these things are cooperating, I will be a cost averager. If it breaks below the range, I have these type of red arrows, which means that I am going to either bite the bullet, take the loss, or I'm going to immediately initiate a short in the form of a SPY or SPX put, because I know that once it breaks below this range, it is going to engage. It's a free zone here, right? It almost looked like that, by the way, on Friday, right there. So I did a short on Friday at a $1.50, $1.60. It went to $4 literally in 10 minutes. Okay, I managed to get out of half of them. I'm thinking, okay, so that's a falling wedge. See that? Let me show you guys this. So I'm looking at this chart. This is a falling wedge right there. And here comes these sell candles. So I'm seeing this. So I initiated the short. I even put, by SPX. It's an intraday. So they're expiring on Friday. So I'm thinking, okay, if it breaks below here, it's going to follow the arrow down towards this 2,700 level. It will be a powerful. This is when the markets went from being down up 160 to being down 25. So this red candle, I'm thinking it's going to expand down. So I sell a little bit more than half the calls. I had a bunch of them. So I'm like, good. I leave the other half in there. Immediately off, this is a falling wedge. See that? So I made a rookie mistake. All right. They're intraday puts because I'm like doing well on my other stuff. I took some nice profits during the day. All my charts are looking good. The biotechs are running. So I'm like, all right, I'll play with this. So and this is a smaller type of trade, but a few of them. So the first one goes great, 100% plus within 15 minutes. I'm leaving half the position in there. This doesn't break down. Immediately off this falling wedge, it creates this immediate green candle. See that? This is reality right there. So I'm thinking to myself, okay, should I get out of the other half? By this time, those things are moving down fast. They go from I managed to get out at around 390. They immediately dropped to about $2.70. Now, this is a secondary trade, so I'm not that concerned about it, but it doesn't feel good. All right, because by this time I've already given back what I've made because the other half is down. So I'm looking at this here. I'm thinking, okay, will it come down? In the meantime, this is starting to move higher. This is starting to move higher. I know, nope. This market, this is a strong market. So the falling wedge broke out. Large bullish engulfing candle. That's known as a bullish engulfing because the body of this candle is bigger than this. So this was supposed to be a breakdown. This was supposed to be a breakdown, okay, like that. But this got too oversold. The machines came in, created this big fat bullish engulfing reversal. So by this time, before I could even react, I'm down 60%, and I'm like, that's it, I'm selling it out. So the last batch that I bought at around $3, the last batch, on the initial trade. The first batch I bought at $1.50. The next one, as it was expanding, I was like, okay, let me buy more. Those I lost about 60% of my money, 70% of my money on that fast. Okay, but I made that decision based on the fact that this was the turn. Now, what I should have done perfectly on that trade is once I saw that bullish engulfing candle. This is a 15-minute frame, right? 15-minute chart. So each of the candles are 15 minutes. I should have just exited the trade and just taken my loss instead of taking a bigger loss on that particular trade. So that's the way it works. So in answer to your question, which I kind of gave you a long-winded answer, but that is important, is stop losses are all fine and good if the overall trend, and depending on how much time you have in hand. If I have a week to 10 days on my options left, I want my initial trade. It kind of sounds stupid. I want my initial trade to be down so I can buy a few more. So let's say I want to buy mentally. You want to buy 6 calls at $3. So that $1,800 you want to put on a SPX trade. All right. So you buy the first 2. That's what I do. I start buying like two increments. So I buy the first 2. I want the market to pull back, so the first then I can buy cheaper prices and get to my 6 overall contracts. Just giving you a hypothetical example. I want to buy cheaper and cheaper prices. So I want the first initial one to actually fall. And given volatility, that's pretty much what happens, because then my average cost let's say my average cost is I originally, let's say I bought at 6, like I said, right? So my average cost will be 4, and I'll be selling it at 10, 12. And that is exactly the case intraday, which gives us the opportunity to buy these things. So I hope that, stop loss answer the question. I'm not because I let's put it this way. There's an old traditional way of looking at things, and this is the new normal that we deal with. So my experience has been that if you follow the old traditional way of this very fixed stop losses, then you are constantly going to get whipsawed by the market, and as the market moves on, you are inevitably going to leave a lot of money on the table. Now, if you don't have any time left, if you just have a day left, or something like that, obviously you want to cap out. You want to take your losses and push out towards the following week. So that's the way I do it.
Frank, can I ask
Yeah.
something?
Yes, of course.
When you're day trading, I see you have a 15-minute. You're on the 15-minute.
I use a 15-minute. I
Frank?
use the 1 hour. Yeah, you go ahead.
Okay, yeah, I just wanted to know what do you find instead of 5 minutes, just 2?
I don't do 5 minutes.
Yeah,
The reason I don't do 5 minutes is because things I do look at 5 minutes too. The 5 minute stuff, which is the old traditional day traders friend, like, oh, trade those 5 minute charts, are so, excuse my French, goddamn fast these days that even
Yeah.
guys like me cannot react to it. However, yeah, that's it. This is because the machines have completely changed the game. So if I'm looking at, let me just do this. If I'm looking at a 5 minute chart, let's say on blue. No, this is not really a volatile stock. This is a beautiful swing trade, guys. These stocks, now that the biotechs are back, I want to get into it right now. I'll cover that in tomorrow night's evening session when I do my free webinar. I'll tell you, big money makers. I've done it before. I'm doing it again. You just got to be a buyer at these levels within this zone. And then when it breaks out, as it's breaking out here, this thing will be 200, 215, 230 bucks before you can blink an eye. That's what these biotechs do. And this is one of the leaders of the cancer CAR T, cancer therapy thing, Bluebird Bio. And we have played Bluebird Bio all the way from down here, back and forth. Anyway, so let's take a look at Tesla. Okay, so this one does a lot of funky stuff in 5 minutes, right? So if you're looking at the 5 minute chart, let's say on a this week, okay, this is what you would be looking at. Now, you can detect the movements as they come in within 5 minutes. Each of these candles are 5 minutes. The problem is that it gives you no directional trend. This one, I would rather look at it on a 15-minute basis, because this one candle, okay, within 5 minutes can disappear in 3 seconds. So this makes no sense to me. Makes no sense to me. This makes some sense to me. This is the 15-minute. But what makes the most sense to me, and each stock has its own characteristic, is the 1 hour chart. So the 1 hour chart is giving me an idea as to whether or not this baby is going to go. And I use multiple platforms as a professional trader. So one of the best platforms I use for intraday trading is not Thinkorswim necessarily. Okay, I use Quad, which is the platform that I use. I highly recommend everyone call them up. They're from Jersey City. They cater to all the big major investment banks. That's how I know from my days on Wall Street. Okay, it's a platform. I know one of the partners. I've been using Quad for 10 plus years. And the show Billions, they actually, that the Quad in the initial season of Billions, Quad was the platform that they showed on their screens. So I looked at it, I'm like, nothing's moving on it. So I call up Keith, the guy. I said, Keith, what's going on here? They have Quad on Billions. That's a major show, right? Billions, right? The show on cable. So by the hedge funds. So he goes, yeah, these guys are such cheapskates. They didn't want to pay for pay for the actual live screens. I'm like, that is so stupid. You're dealing with like these billion-dollar hedge fund players, and they have static screens. All the traders are sitting in front of screens with static charts. I'm like, this is hilarious. Anyway, so I use quad quite a bit on looking at the candle formations, but toss is fine. So this, depending on I use I'll quickly look at 5 minutes, but I'll look at the 15 minute, the 1 hour, and if I want to stick with the trade intraday, I will be looking to see whether something's overbought or oversold on the 4 hour chart, which is the second cousin to the daily. Okay, so the 4 hour, when it gets this oversold, it generally portends a powerful buy. So you can just don't take my word for it. Look at it. Look at it here. And I'm very successful in trading Tesla overall. Look at the 4 hour. Look at where the 4 hour is right now. This needs to go down a little bit more. So Tesla at this level here is a powerful buy. It's going to basically, this is looking, what type of pattern is this? You guys see it? Oops. What is this? Huh? Somebody said it.
Ascending triangle?
That's right. It is. It is an ascending triangle within this framework. It's not one of those big Apple type of ascending triangle. That's over 360. I have no idea it's going to do that. All I know, this
Looks like a cup with a long handle too.
Oh yeah, exactly. You're seeing that. So bottom line is, it's a very long handle, so it's a trading range. So I wouldn't, I would call that a cop, yes, and that's why I have these lines drawn here. So bottom line is, if this breaks out over 310, and I've been saying 310, this has been a major resistance level here. Okay, and don't believe any of this garbage that these analysts talk about on Tesla. And I'm not in love with Tesla either. I don't even like Teslas, just so you guys know. We're big car guys here. My son is a huge car guy, and we like gasoline-powered V8, V12 monsters. All right, but I don't even care about Teslas. My neighbors have it and stuff. I like cars which make sound. But to make a long story short, this stock is going to break out. I'm telling you, it's going to break out. And in between, it is getting now on the 4 hour. It's getting very deep oversold. Love it. Okay, look at that. Every time it gets there. And these are the times you could have done quick scalps. Look at here. The 4 hour made a double bottom. Stock made a major double bottom. And I bet you at that time, the analysts and the idiots on TV and all the crowd on Stock Twits and other forums, they say, oh, short the stock, And we were actual buyers of the stock because this created a beautiful inverse head and shoulder and a monster move from 250 up to $350 in just a matter of 2 days. All right. So here, if it breaks out 310, first level of entry is right here at this level. I mean, first level of contact is 320. Making some real decent money. Now, don't go overboard with Tesla, but it certainly looks pretty damn good. This wide channel, if it holds, you're looking at a move up towards the 350 level. And for Tesla to go from 310 to 350, it can happen within an hour on a major announcement. And I know what those announcements might be. And it's not anyone who really understands, SpaceX, that's his baby, right? And what if he says SpaceX and Tesla, that they're going to be spinning off SpaceX, and I come from the Wall Street side, I'm sure they're talking about it, as a separate company with Tesla as an IPO, with Tesla being their largest shareholder, Elon Musk. What do you think that's going to do for Tesla stock price? It's going to go up $100 within a day, probably. You understand what I'm saying? There's a lot of unlocked value. What if Tesla says we are separating our battery division and spinning it off as separate IPO? That's what, investment bankers do. They unlock potential, intrinsic value within companies. Anyway, to make a long story short, I look at so that's the answer to your question. Now, last thing here is 11:23. Okay, so an hour. I don't want to keep going. So I look at, this is the way I do it. Just a quick thing on my methodology, and I do a lot of stuff, so I can't explain the whole thing. Is everyone has to develop their own style. This is your short-term chart, keeps you on the track. You don't panic. You basically look at things. I put levels in gear where things will hit or not hit And if it does break that, you want to, I'll put out a quick short. When I do the shorts intraday, I'm rather quick on it. A bunch of times I'm a little bit early getting out on it. I should have left it there because I'm scared that these machines, which are so powerful, believe me, they can wipe out your, let's say you're short, you bought some SPY puts at 60 cents. You see it at $2 because that's what happens, right? You see it at 2.5. And within seconds, they turn around and wipe you out. So this is, whether one likes it or not, we're in a bull market, and bull markets have correction. And bull markets, you want to be quick on your short trades and you want to be patient on your long trades. Okay, so this is your trader chart. This is the chart that makes the big money, to stick with the plan, right? So this is a very simple chart, and I've shown this as clearly as possible. This is your 2018 break-even level. We went well below that, past that. Now this is the futures chart, not the actual S&P chart. This is where we are. What is this? This is looking like a rising wedge, right? This is looking like a rising wedge. We are getting to the upper end of this move here. And that's the reason why I think we have just a little bit more room to move. That's from 2732 to this level here. Now, how are these lines drawn? These lines are drawn because each of those levels where the big supply came in or sell programs came in. So all I did was simply join each of those lines. I mean, not join, just draw each of these horizontal lines on that. It's very easy, guys, because these are the levels that the algos will engage, try to break out, or fall from. Do you guys understand that part? So this is your ultimate swing setup. Now, given pattern symmetry and the push that this market has, the market has some real animal spirits now, right? You notice how quickly the market can change its mind because it's all really a manipulated game. All right. The analysts were like, that's it, we're going to go into a recession, blah, 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 blah. In the meantime, 80% of S&P company earnings that came out have blown away their numbers, with actual numbers. Revenue growth, their guidance has been good. So, and you don't want them to be like completely, and each of them have been rewarded based on their numbers. Priceline wasn't rewarded based on the numbers because they had slightly weaker numbers and weaker guidance. Apple was very well rewarded because the numbers were blockbuster. So this is a stock market, honestly speaking. So a stock market, you look at the overall picture and you reward companies which are doing well. And that's exactly what the market's doing. So saying all that, given the power in each of these candles, this is your daily chart, not the 15-minute back and forth. Stop loss has been taken away and people are like, oh man, I should have held it. I should have bought it, and the same old stuff you keep on hearing all the time. It tells me, this is my gut feeling, that we are going to basically at least get up to that 2744 level. That's what I'm looking at. That's just around the corner. It's just here. We might get that first thing on Monday morning. Barring any cataclysmic event on Sunday, the market should gap open towards the 2740 level. And at that point, so each of these levels, when and this is the way I do it, as each of these levels, because I'm a buyer at these levels, you guys know that. I'm a buyer at these levels as it broke out. All right. And this is where you pedal to the metal. You want to go in really hard at these levels. And as it climbs higher, the width of the length of the candles gets smaller and smaller, right? That's just the way it works. And so as each of these levels are engaged, I take down some profits and I move up my strikes. Don't forget, all the way down here, when nobody wanted to even touch the market, all right? And our chat room's pretty damn quiet these days. I like it. You know why I like it? It just shows the amount of fear, despair, and regret that's out there. The minute it starts to get too hot, that's when you know the market's topping. Believe me when I tell you. All right? Now everybody's, excuse my French, shit scared. They're still scared. Oh, the market's too high. Oh my God, if I get in, it's going to crash like this. Like we say in New York, dudes, it doesn't work like that, okay? So it's so right now, given the ferocity, we should be breaking out of this rising triangle, or even this is more like a pennant. And if we do break out, then the level where the real ugly selling came in is 2756, and that's why I have those big arrows here. And then I have this broad channel. You guys can see right there. That broad channel is also engaged at around, well, that's engaged at 2770, but I'm not going there. I'm saying, like, at this level, a lot of big money just went boom. So obviously that's going to be a resistance level, 2750, and that's also a very decent sum of money. That's actually very close. We closed around 2730. Okay, so 2756 is 26 points more. 26 26 handles or E-minis is roughly 7 times that is the Dow Jones. So we're looking at a 182 point move on Dow Jones from here to here to complete the first stage of the pattern. Now this is, I'm showing on this chart. This also correlates with Thinkorswim. So you guys understood what I just said, right? So as each of these levels are hit, I take down some profits, move my strikes out, and I keep on looking during the day, and at the end of the day. Obviously, I'm constantly looking at this to see if this is turning blood red. If that's the case, that means some real power sellers are coming in. Do you understand? So that's just the way it is. This was a major resistance point, because this is where it moved higher, everyone got happy, and bang, they hit the market. Markets are vicious animals, all right? So that we beat them with our charts and my, my experience and knowledge, the few brain cells I've left in my head. So bottom line is, once this got taken out, the shorts are like, that's it, guys. The dogmatic shorts, the ones who are really like always shorting the market, they're like, no way, the market can't go above this. The minute it breaks out over that 2713 level, 2714, you can see that clearly. They're covering. They're like, that's it. We're getting out. So as the shorts are getting out, these are the final stages of the journey before the market pulls back again. Now, that's one way. So this chart is very simple with the levels. So that's the way I do it. Now, looking, if you want to look at the actual SPX, there you go. So this is a very clean chart too, guys. So here's your 2018 level, right? This is 2018 started. This, by the way, when the chat room was very full, guys, just so you know, all right? Because markets were up every single day. And I'm looking at this, and you listen to my videos from that time. I said, you know what? This is going to not end well, even though I was trading on the long side. And I said, this is wave 5, an Elliott wave theory. You call this wave 5. Wave 5 is known as euphoria. That, Mary Beth, is called the ultimate comfort zone. And that leads to massive discomfort, as you clearly saw. All right? So this is known as a wave 5 euphoria stage. So, and this is when everybody's like super excited. Oh yeah, Amazon's going to go here. Amazon did go there, but everyone's just like super excited. They become reckless. At Clueless Day Trading, dead serious. We are never reckless. Do we get excited? Absolutely. I never get reckless, because I've lost money in years before that you guys don't even want to know. All right? And I've made back 8 to 10 times of that. So bottom line is, at this stage, this is your acceleration channel. This is very clear. Niraj, if you see this one, I'm sure you've seen it. Here's a gap. I keep on showing that this gap is going to get filled. It's right there almost. Now, as in pattern completion, you guys can all see this. This is a beautiful, lovely, multi-bottom, dragon bullish. First level of completion right here. Second level of completion, 2800. At 2800, there has to be some big selling. And if it's not, then it's going to be wave 5 euphoria again, which means the market's going to overshoot and crash. End of story. That's exactly the way it works. All right. So if at this level here, 2750, there has to be some level of selling. All right. So if that some level of selling comes into place, it can still be something like this. Remember, this is a dragon bullish. Can somebody tell me where the pullback would be? The pullback, ladies and gentlemen, would be right here like this before it continues its journey. You tell me, all of you guys, that this is not a pattern. Okay, so that's what's going to happen. The minute it hits this level, it's going to pull back from 2750, close to it. 2750, it's going to retest this massive downtrend line. Remember the downtrend line that broke out 2 days ago? That downtrend line is 2698. Once it hits 2750, we could very well see a pullback to test the neckline. Remember, this is the neckline, right? That's your neckline right there. This white line here. So neckline breakout. So Neeraj, this is some of the things that, questions you were asking regarding, like, ascending triangle breakouts. The neckline breakout completes the pattern, first pattern. The real pattern is completed here. So 2750 immediately creates a handle. Immediately creates a handle to retest the downtrend line. That's 50 points, ladies and gentlemen. That's 350 Dow points. It's going to happen within 48 hours. Or maybe if the faster it happens, the better. And we will be shorting it depending on what signals we get from here. So this is pretty much how the markets do things. Now, why is this still why is there a good shot that it will break out towards 1800? Just look at the stochastics. And this is why I keep on showing the more simple thing. Does this look like something that's about to just collapse? Sure, it can. I mean, we know that. But given where we are right now, I was showing this well before. And Neeraj, you know it from my previous videos. This was a positive divergence. We were hitting the same levels on the market. Okay? We were hitting the same levels on the market price-wise. But look what the internals were doing. They were making higher lows. I clearly wrote it down and showed it. Guys, this is a positive divergence. Everyone is completely, absolutely terrified. Like, oh my God, here we go again. Here we go again. Just looking at the levels. This white line is a 200-day moving average. Constantly retesting it. I'm noticing higher at the same price, low price levels, testing the 200, but higher stochastic, higher lows. What is it telling you? That the market's going to go
Frank,
higher. Yeah, go ahead.
Frank, which divergence is more powerful, stochastic or MACD? Your experience?
My experience, I have had both are very powerful. I believe the stochastics have paid me more money in my pocket, so I have to pay. I would say that stochastics are more real time than the MACD. But I mean, I don't show the MACD here, but I believe the stochastics are easier to read on the eye, too. So both, you can mix them both, but I like the stochastics more for trading purposes. And the more you utilize this, this is a longer term chart, right? This is a daily chart. So it spans a full year, for example, year to date. So you can clearly see. So looking at the shape of this here, because MACDs, a lot of the times you can't see the shape, right? You just see the histograms going higher. So here, the shape is telling me that this is powerful. Now, is it consistently going to stay above 80? Like it did during January to all of January, basically, till the end of January. I don't know, because if we do that, if it stays sideways like that over 80, the market's going to hit the new highs. I'm telling you right now. But we don't know that yet. All I know is this is looking damn good for the month of May, and that is basically with these levels here, 2750. I believe by the month of May, which we have 2 weeks left, in between those quick pullbacks and stuff, we are going to hit 2800. And you can test these theories out by simply buying maybe one call at 2800 and you see how it goes there. And believe me, I played the 2700, if you remember, and I just kept on buying. They went from $2.50 to 24 on Friday. Okay? And I keep on showing it. So I had May 11th, I had May 18th, and I sold some along the way. I bought, but my average cost remained around $2 to $3. They actually went to 27. All right. And those were bought all the way down here, guys. Remember? I mean, I said, and of course I bought in the money calls too. But I bought them believing that we are going to go back and retest the 50-day moving average and go break even for the year, which was around the 2700 level, and the downtrend line, which was exactly at the 2700 level. That's why I bought the 2700. Markets always love retesting downtrend lines, always do. So that's basically it for now. Any quick questions, Kathy, if you can hear us? Mary Beth?
I have one question. How do
Go
you
ahead.
calculate the movement of the Dow versus the S&P? Like, if
7 points.
okay,
So, roughly 6 to 7 points. So one S&P points is 7 Dow points.
okay. Great.
So if the S&P moves 10 points, it's roughly 70 Dow points. Yep.
Is there any ETF for the Dow that you trade?
DIA.
TIA.
We have traded DIA options. I haven't done lately. Thanks for reminding me. They move and they're cheap. They really move. I remember we played it, I think 3 or 4 times. They're cheap. They're like 30, 40 cents. They go to like $2 because the Dow moves like that, right? So, yep, they're the DIA options. DIA
Thanks.
calls and puts, correct. SPY puts, calls and puts, great. SPX, great. And remember one thing. Now, the last thing I'll tell you, Niraj, what do you call, is when you look at options and you see the premium stuffed, meaning it's inflated, they look so expensive because those guys and those machines and those Chicago guys, remember, options market makers are real bastards. All right, they're always trying to take money away from us. You know that, okay? Really, I mean, and so these guys, when the machine, but nowadays the machines do the revaluation, right, of the options premiums, all the different, delta, gamma, theta, and all that stuff. Um, when you see them stuffed, like you're looking at the 2800 calls, and they're like, why are they $7? It's so far away because they know it's gonna go there. You get it? So they keep on. Yeah, it's the same thing with stocks. Like when what do you call it? These right before earnings, they stuff the premiums, and he's like, "Why is it so expensive?" A lot of the times it's because they're going there. So I don't know what these 2800 options are right now. I'm going to look at it right now. So I'm typing in on my top screen SPX. Just bear with me.
Do you still buy them when they're so inflated?
If I think it's going to go there, yes. If they're, I mean, that's kind of a black and white question. So I make a determination whether it's worth doing it. But if it's, it depends on how expensive they are. But
sometimes I've bought options and
Mhm.
then for earnings play, and they beat, and the stock has moved, and the options have actually decreased a little.
Yes, I know, because that's a premium decay. If the stock hasn't moved a lot and you bought a little bit out of the money, they're not going to pay you. So what I tend to do with earnings, where I just buy like maybe 1 or 2 calls each of the companies, right? Like I always do a basket. So whichever one hits, boom. And a lot of mine hit. Some of them don't hit. So I'm still coming out ahead. Is I buy in the money.
In the money.
In the money. Okay. So if I'm going to pay $8 for it, fine. I'll buy one for $8. I'm not going to buy way out of the money like I used to when I was doing my trading. I'm like, what the hell's going on? The stock's up $20, but I bought maybe $20 out of the money, and guess what? They're going to deplete your premium, and you're losing money fast. So I buy in the money. So let's say, for example, I'm looking at the 2800 options here, and the last day of May on the weeklies is May 31st. So let's look at May 31st, what the 2800 calls are. This is so crazy. When I look at the options tables, they start the options at 1200. I mean, this is, the strikes, 1200. I remember SPX at 1200. All you heard was, no way can this market go higher. It's already doubled from March, from 2009. I'm like, oh God, here we go again. You hear the same story again. Seriously. Markets get complete bubbles and tops are reached when everyone's feeling good. And we are very far from that. That's the simple truth. So saying all that, let's look at 2800. So get ready, guys. As I said, there's a lot of, there's 13,000 contracts bought. I mean, they're sitting there quietly, and they're not expensive. They're 13,000. They're $3 and oh, you'll be happy. They're $3. I'm buying a bunch of them tomorrow, or I want a little pullback before I buy them. So I might get that pullback on Wednesday. Yeah, and guess what? The highest open interest, right? At least what I can see from my side, 13,000 contracts sitting at 27.95. 13,000, and they bought more on Friday. 1,500 of them. It is another, whoever this buyer is the same buyer. Bought another 1,550 contracts of the 2,800. 31st May. S&P calls at $3. And guess
So
what?
Frank, where are you seeing this?
On my options table on Thinkorswim. Here, hold on. 1 second. Let me detach it.
Okay, level 2 you are seeing?
No. Just regular options table. Let me show you. 1 second. Like, where do you find your options screen? Yeah, just open your options screen. I mean, do you use Thinkorswim?
Yeah.
You do? Okay. So then let me show you. I'm moving my screen here. Thank you very much. Screens changed, right? Yep, I'm on my option screen right now. Neeraj, has your screen changed?
Yeah, we can see your $1 million account.
I know, I was gonna say that. Don't insult me. Why are you insulting me with $1 million? I'm trading with about 2 billion, What can you say?
Yeah.
Yeah, exactly. And you can't even see it. It's hidden somewhere in the universe, in the black hole. Yeah, that's kidding. Okay. If I was, what platform? All right. So here is where I'm seeing it. Look. See? There you go. So I look at options tables quite a bit, by the way. And another thing I do is I chart options, as you know. I don't have the time during the day to always put out options charts, but for S&Ps, they work pretty nicely. So here is what I'm seeing. See the open interest right there?
So Frank, what is the difference between volume and open interest?
Open interest is the amount that has already been bought and placed, and the volume is what was done that day. So this was Friday's volume.
Okay.
That's Friday's volume, and so look at that. 13,000 of them are sitting quietly at 2,800 because they know one with the other, and we just discussed it on our charts. We're going to 2,800 by May, end of May. It's funny, but believe me, that's what they do. Now, on the put side, if you look, this is open interest. You're not seeing any major open interest. 1,950, 3,900. You see what I'm saying? And maybe if we go more back, like, okay, there's 11,000 here at 2,650. But again, this is not necessarily a really powerful indicator, but it's worth watching. But I like the fact that $3. Now look, over 2,800. Watch this. The open interest falls quite rapidly. Somebody's betting 28.25. There's 6,400 at $1.30 sitting there. Oh wow, there's 17,000 sitting here at 60 cents at 28.75. That's big. Yeah, somebody, because remember, there's a lot of big players who buy these 50, 60 cents ones, and they buy in size. Because 17,000, let's call it 17,666. That's 1.7. 1.76 million times 0.5. So somebody has $883,300 bet that we're going to 28.75. That's what it comes down to. Okay, guys. So everyone's good. Just a quick thing here. What platforms everyone uses with reasonable ticket charges? I like, well, what platform do you use? Thinkorswim? I use Thinkorswim.
I use Schwab.
Okay. And I
So
love
I
to go ahead.
yeah, I use Thinkorswim, and recently, so Frank, I have subscribed to this Robinhood also.
I know. I heard
This one, this
Robinhood.
is free, no commissions.
I know. I know. These guys are getting big. Now, what's the story with Robinhood? You can trade without commissions?
Yeah, so their model is more like whatever money you are putting, so
Yeah.
they are investing that money, so they are banking on that, and then they have a gold membership, which is like they will give you double margin, and then you have to pay $10 a month. So what their claim is
Mm-hmm.
that it takes very less today to do the trading, and
Mm-hmm.
so E-Trade, they were giving an example that they have 3,500 employees, and whereas they are managing their whole
I know. I know.
operations by 100 people.
I saw the interview. They're very smart guys. In this Indian American guy, right? I was
Yeah,
looking.
yeah, yeah.
I was seeing.
Baju.
Yeah, I know of Robinhood for many years, but now they're gaining some traction. I do Thinkorswim. I used to use E-Trade, but I Thinkorswim is just fantastic. I've negotiated the commission rates with them because I'm an active trader, so they give me roughly about 75 cents a contract, and that's okay
Yeah,
with me.
I get $1 a contract.
That's fine. Remember one thing here. We're not doing like hundreds of contracts, you know? Yeah, sometimes I'll buy
Yeah,
200 contracts if it's like the Bank of America Lotto, right? Which I trade pretty, they're like 8 cents or 9 cents. UTX is a great trade. I had like a lot. I had like 300 contracts, at the from the 18-cent level, which went to 79 cents, by the way, on Friday. Those are big money makers. You don't have to worry about, seriously, that's a beautiful trade and it's still going. UTX. You got to buy them cheap and you just keep on adding them, keep on adding them. US Steel's the same way. You buy them cheap and you keep on adding. But UTX chart, I
yeah,
like.
that was a good call.
Yeah. And it's
US
just,
Steel was very good call.
yeah. And I'm telling you, UTX is just starting. Okay, I don't want to get into it right now, but look at those charts on UTX. And don't forget, United Technologies right now is in the process of, in the hands of a major activist investor, Third Point. And Third Point? Yeah, that's what they call him, Loeb, Michael Loeb. He wants to break up the company in three pieces. Do you know what the stock's going to be?
Hmm.
The stock will jump $40. And so this is like huge. So this is not just a chart play, it's a restructuring play. All right, guys, have a great morning, great evening, weekend. I just gave you a little sample of things I discussed. There's a lot of fun, exciting stuff that I teach on my advanced coaching sessions. So Mary and Katie, when you guys are ready, sign up for the ACS. You will just love it. And by the time you get, by the time you actually see those things in motion, which is pretty much immediately every day, and all the different interactions, there's a whole bunch of things that that I cover. So on that note, I want all of you, please. We started our Instagram account. We're getting exposure on the social media side. We definitely need to grow our membership because we offer such phenomenal results. But our membership should be 1,000 people, to be honest with you. We're sitting between 100, 130, that sometimes goes to 200, like, when things are good and people are feeling good. But honestly speaking, the caliber of content that's being delivered at Clueless Day Trading, honestly speaking, through all types of markets, because and all of you, Neeraj knows that at least, I'm there on a bad, ugly, really ugly day, telling people to stay calm, where they need to buy, what they need to do. I'm walking people through this whole soap opera we call the stock markets. Okay, we need to have a lot more members. Please, referrals, please. The Instagram thing, that's the least I want you guys to do. Go ahead and click follow, and please tell all your friends and anyone that you feel comfortable just to follow. That's it. Let them see some of the examples of stuff that we do. Because my social media guy, who's also a trader, is the one who's managing it. So he's putting up a bunch of my trades. He's putting up some charts, things I've said which have come exactly correct or not correct. It's there. So it's a valuable resource. It doesn't hurt them. It helps us. We need to get to 1,000 plus followers very soon. So just please spread the word. That's the only request I have, guys. All right. So have a good one. If you can,
Thanks so much.
stop by the webinar on
Thank you, Frank.
Sunday evening. And now you know what we're doing. And in the meantime, we just got to control our trades. And that's the tricky part. In the meantime, we're pretty certain that these levels will be engaged. Have a great weekend, guys. Bye-bye.
So Frank, when are you planning for next ACS session?
The next ACS session, well, the free one is tomorrow evening, and the next ACS session, depending on, I can always do it after the market on weekdays,
Okay.
or early on Saturday, so we can work that time out. All right.
Okay.
So,
Thank
yep,
you.
absolutely. I'll be in touch with you. Thank you, sir. Bye bye.
Thank you.